Hello and welcome back, everyone. Today is a bit of a special session. Why? Because I have one of my favorite colleagues at INSEAD, Professor Pushan Dutt, joining us. Thank you, Pushan, for making time. Pushan is a professor of economics and political science. Now, this is a time where this is potentially really important here for us. And what we will do today, I asked him to join me to have a conversation what he sees in the political space, in the economic space, in the macroeconomic space. Obviously, I will make sure we keep a close eye on the impact on private equity, potentially venture capital. So let's start off. So trade and tariffs. We're sitting here at the end of the first quarter of 2025. So obviously the world is a little bit in upheaval. Tell me how you think about trade, free trade, the importance of free trade, and potentially the threat to free trade due to tariffs.
So if I take a step back and think about globalization in general, so historically, I might bring in history every now and then, okay, because
perfectly fine.
Many of the things we think are new, actually our ancestors have experienced them in the past. So globalization, essentially, there have been three waves of globalization. Okay, the first one was triggered by the invention of the shipping container. Okay, and that's when actually goods started moving across borders. So this is the 1930s, 40s, post-World War, and all the advanced economies gained quite a lot because of that. Then starting from the 1980s, factories started moving abroad. Okay, so that was the second wave of globalization. So sometimes this is also called the China shock. Lots of companies basically took parts of the production processes, moved them into developing countries, mainly China, and this leads to the rise of China. Okay, this benefits China, of course, but it benefits all of the advanced economies as well. Why? Because they get better quality goods, they get cheaper goods, and more variety of goods. Okay, why is variety important? Just walk into the MRT and look at people's shoes. They're all wearing different shoes. We like variety. When I was growing up in India in the 1980s, everyone wore the same shoe, okay, and drove the same car. Not a good world to live in. Okay, so that's the second wave of globalization, which actually starts coming to a halt around the global financial crisis, right after the global financial crisis. So today we are in the third wave of globalization, where offices are moving across borders due to, accelerated by COVID, accelerated by technologies like Zoom. So that's where it sort of sits. But, starting with the Trump administration, there has been a massive push in terms of tariffs, in terms of trade wars, and this has actually accelerated a lot this time around.
So now a little bit on tariffs. Are tariffs good or bad for the country that's imposing them?
So whenever you ask economists any question, they will always say the answer is it depends, okay? And the answer to that question is also it depends, okay? So if you're a small economy like Singapore, okay, so, your demand or supply, your exports or imports are not a big part of world trade, then the optimal tariff for you is actually zero. You want to get the goods cheaply from outside. You don't want to make everything. It's just very inefficient. Okay, this goes back to David Ricardo's theory of comparative advantage. Now, what if you're a large country? Well, if you're a large country, then if you have some buyer power on world markets, so think about in the context of business, Apple has some buyer power. So what they can do is by restricting the amount that they buy, they can actually drive prices down. Economists call it monopsony power. So if you're like a big purchaser of, soybeans on world market, like China is, then you have buyer power. So there, if you put up a tariff, you can actually drive the prices in the exporting country down, and that gives you an advantage. Okay, so the economists call this the terms of trade argument for protection. Yeah. But here's the problem. As soon as you put two countries together, and then they each try to exploit their buyer power, then, the gains from trade, the size of the pie essentially shrinks, and they start hurting each other massively, right? So unilaterally it might make sense for me to try and exploit my buying power, but if all big countries in the world start doing that, which is what they did, right before the Great Depression, okay, these were called the Smoot-Hawley tariffs, then this shrinks the size of the pie, reduces global trade, and that's also why the recovery from the Great Depression was very long. It's a very ancient, weird, mercantilist way of thinking, which is that I just want to export and I don't want to import, but then everybody loses. Now, one of the things that people don't understand, okay, they think that trade is about exporting, but trade is more about importing, okay. Why do we need to export? Well, because we have to pay for the stuff that we need to import. It's a little bit like saying that, what really matters for me is working. No, what really matters for you is you get money and then you can go to Bali, sit on a beach and sip a drink, right? This shows a little bit of confusion. So trade is actually a lot about imports. You get cheaper stuff, you get better quality stuff. You can actually, even for exporters, what really, supposing you're an exporter, why does free trade matter for you? Well, what you can do is a lot of world trade is in something called intermediate inputs. Okay, so think about a car, the steering wheel which goes in, there is some software which goes in. So all these things go into the car. Okay, so these are intermediate inputs. The car is what is called a final good. So if you're an exporter of a car, you want these intermediate inputs to be of very good quality, good technology at lower prices, and that's what trade gives to you. So even exporters would actually want free trade. Okay, so and the last thing I want to say is that if you look at the global international trade order, which was put in place by the U.S. Post World War II, it has benefited the world as a whole, whether you think about Singapore, but most importantly, if you think about China, if you think about the US, if you think about Europe, it has benefited countries a lot. Countries which have actually stepped away from global trade, like India, for instance, which has always been very skeptical about trade, they still haven't performed as well as a country like China, right? The irony is that if Trump comes in with reciprocal tariffs and forces India to actually liberalize and bring its tariff barriers down, okay, that would actually be good for India. It'll be kicked, dragging and screaming into liberalization, but it would actually be good for India.
Potentially getting it to really compete with China.
So now what we have is that there's a geopolitical aspect to it, right? So the geopolitical aspect cannot be disconnected from the trade aspect. So basically, the U.S. has a supply problem. They can't make anything. Okay, they make services. They're good at services, but not in terms of goods. Okay, not in terms of manufacturing. China has a demand problem. Okay, they can't seem to consume anything, so they're trying to export their way out of trouble, right? So this actually is something which is an imbalance. Sometimes economists talk about global imbalances, and this was the trigger for the trade war during the first Trump administration. Trump, of course, focused on slightly irrelevant things, okay, but he had this intuition that the US is importing a lot and the other countries are exporting it and using the US as a market, and that there needs to be some rebalancing. So that is so he tried tariffs as a way to do that, but economists will say that might not have such a big influence. The big issue is that the US dollar is the world's reserve currency. Okay, everyone wants to buy US dollars, especially during times of uncertainty. It's changed right now, but in the past. So what does that mean? That essentially means that the dollar is very strong. If the dollar is very strong, it means that US exports are going to be low and their imports are going to be cheap, and I'm going to get an imbalance, right? Now, within the Trump administration, there's something called a Mar-a-Lago doctrine. I don't know if you heard about it.
Yep.
I'm sure all cocktail parties, that's the hot topic of discussion, which is about...
At least right now.
which is about weakening the US dollar. That's not going to happen, okay, because Trump does not want that to happen.
It has happened a little bit now. Right.
It has happened a little bit, but not because they... So some of the things that they've proposed is a little bit within the Mar-a-Lago doctrine is it's a little bit crazy. Okay, so it's saying things like I'll take all the U.S. treasuries and convert them into perpetuals which are not traded on world markets. It's essentially an extraction scheme. Okay. Countries have tried to, renegotiate their terms of their debt and things like that, like Argentina, and it has never gone well. This is actually a little bit worse than that because Trump's chief economic advisor is saying, okay, we'll give you lower tariffs, we'll give you the security umbrella. In exchange, you lend us money for free, basically, right? Of course, if that happens, it means that the faith in the US dollar, the faith in the US Treasury gets destroyed, and that is going to create so much uncertainty, which is the reason why we are seeing, for the first time in history, gold appreciating while the dollar is depreciating.
Yeah, very good. So, which kind of gets us to the point that obviously governments, countries can take certain steps. So for a large economy like the US, stepping out and saying tariffs and potentially multiple layers of tariffs on top of it, what's a good defense against that? Because we have like a lot of new governments right now in the larger economies that are now sitting there and saying, what are we going to do? Are we going to play nice, retaliate? So what's the arsenal that you have?
So there are three models going around right now, okay? One is the Mexican model. The Mexican model is roll over and play nice, okay? Try not to attract attention, like a puppy dog ploy.
Lie low.
Just lie low, and hopefully you will not be noticed. I don't think that's going to work, okay? Because Mexico is a big trading partner for the US. The second one is the Canadian European model. Okay, the European model will get triggered starting April 2nd when new tariffs come in. That one is we are going to retaliate. Okay, we are going to be tough bargainers, and that's what the Europeans did last time as well, when Trump put a lot of tariffs on goods like steel, aluminum, bunch of stuff. The Europeans started targeting tariffs towards things like Harley-Davidsons, because Harley-Davidson comes from Wisconsin and Paul Ryan was the House Speaker at that time, or Kentucky bourbon because Mitch McConnell was the US Senator. So it really hurt the red states, essentially, right? So that's what the Europeans are going to do. That's what I think the Canadians are going to do. The third one is the Australian model. The Australian model works like this. Recognize that retaliation actually hurts your consumers, right? Because the prices go up. It's like a tax on consumption. So make very strong statements, okay? Fan out on the world media, but actually don't make it worse by retaliating, okay? So we don't know which model is going to work the best, but let's see. I think it definitely depends on the size of the country. For a country like Singapore, the Mexican model is the best. Okay, lie low. For a big, keep in mind the European Union is as big as the US in terms of percentage of world GDP. The Canadian model is the best model for them.
Yeah. Well, we'll see how this will plays out. And let's have a conversation on kind of overall geopolitical shifts. From where you're standing, because quite a lot of the private equity and certainly on the venture capital side, this model has all gone from being, let's say, 10, 15 years ago, reasonably local, right? You did with boots on the ground, and wherever you were, you made your investments, to nowadays a lot more, let's become global. Okay, I've done my European market. Now I'm going to do Middle East, maybe Asia, maybe I'm going to have a look at Africa. So tell me about geopolitical shifts. Like, how has the world kind of changed? And maybe if you can, forward-looking, what should we expect in the reasonably near future?
It's always tough to forecast because forecasts are about the future. So I think we are in the midst of a massive geopolitical shift, okay, which has been happening. The entire alliance structure that has existed again since Second World War, which was of massive value to the US, it's essentially being discarded by the Trump administration. It depends on which of the factions under Donald Trump actually rises to the top, okay, so. And I would identify maybe 3 or 4 factions, okay? There's one faction which is an isolationist faction, okay, which is saying that the US is surrounded by oceans and it should just focus internally, okay? And it should not interfere anywhere in the world. In that world, essentially, I would say that China and Europe take a much bigger role. Okay, if the U.S. becomes truly isolationist, there's a second faction which says that the U.S. should be the global hegemon. Okay, and we should continue along this path. Okay, so in that case, if I'm an investor, I would just think about which sectors should I invest in. Okay, and I would still have some diversification strategies in terms of investing in China. It's more about competition with China, between U.S. and China, more like the world under the Biden administration. Okay, the third one is which is that the world gets divided into spheres of influence. Okay, so the U.S. has had a hub and spoke model, right? So I've got Japan. So the U.S. essentially is the hub, or you can think of like a local geography as the hub, and the U.S. supports that hub. So you can think about Japan and South Korea in Northeast Asia. You think about Europe. You think about so it has force projection. It's there in the Middle East and things like that. That model, I think, is getting replaced by what is called the spheres of influence model, which is the Chinese are dominant in Asia, the Americans are dominant in North and South America, and the Russians are dominant in Europe. Okay, not the European Union, but the Russians. So in that model, essentially, this is what the Europeans really fear, and therefore they are investing massively in defense and manufacturing. So that's, I think, where the major pivot is going to happen. So if I were an investor, I would start looking at Europe really seriously because it is an existential threat for them. Of course, the Europeans squabble a lot. They can't agree on anything. So Spain does not want to contribute to defense expenditure under NATO targets till the Russian army reaches France, at which point in time I think they'll wake up. But
you could also argue that this kind of pressure may actually bring Europe together for the first time since the 1950s.
Correct, exactly. I don't think they have an option. They have to sort of come together. There are still uncertainties left, like who will be the leader of France going forward. But I think this has been a key wake-up call, especially to Germany, which is known for dithering on foreign policy and economic policy and things like that.
And not wanting to spend.
I'm not wanting to spend.
So I think we kind of like at least are trying to come up with a way around the debt ceiling. So we will see how the execution works. But I guess what you're saying is Europe's only way out, or the European Union's only way out, is to become a sphere themselves.
Correct.
Of influence.
Exactly. So they which means that they have to make lots of tough decisions in terms of investment, in terms of spending, in terms of taxes, but most importantly in terms of their social safety nets. Okay, it is going to be very difficult, not for Germany, but given so much little fiscal space many of these countries have, like France, for example, or Italy, that they have to make really, really hard choices. That if they are going to pivot away towards less regulations, less of social safety nets, but more of spending on manufacturing, spending. Europe is actually still very strong at manufacturing. They're actually much stronger than the U.S. But they really sort of need to spend. Okay, so this is an old European mentality that saving is good. We see this in Asia as well. Spending is somehow bad. Okay, as an economist, I find it very weird because when we write our models, there is spending in our happiness functions, not saving. Saving, looking at my bank account really doesn't
make you happy.
Doesn't make me happy. Maybe it does in a mental sense, but it's like really going to the bar that makes me happy.
Yeah, and I mean we've actually seen this also when you just look at something very tangible, IPOs. Right, so European IPOs tend to be a much more muted experience, to say the least, rather than even during good times, than the very positive, very enthusiastic kind of IPOs in the US and to some extent also Hong Kong and China. So good. So let's go from the big picture. Let's go to something much more closer to home for anyone interested in buyout funds. Interest rates. And the Fed interest rates and liquidity, so something very close to your heart. So where are we right now? So we had obviously a decade ago, post-global financial crisis, very kind of loosey kind of policy with regards to liquidity, lots of liquidity, low or no interest rates or negative interest rates. And then obviously that kind of interest shock, which really was only a shock for those that hadn't been around the first cycle or pre-global financial crisis. So it's not the first time that interest rates had been at that level, nor were they particularly high by historical standards. But now with interest rates coming off again, I mean, what's your view now on the Fed rates, the influence of the Fed rates still on the global behavior when it comes to interest rates?
Yeah, so, the spike in inflation was something which we had not experienced for quite some time, right? So it was called, the entire era was called the Great Moderation, right?
Yep.
Now, and I think a big generation of investors actually grew up without really understanding what inflation is.
Absolutely.
And,
it was literally risk on. The argument was we kind of managed to put risk in the box. There is no more risk.
Yeah.
Let's take lots of it.
Correct, exactly.
And that was literally, and for a decade, right?
Yeah. So, I would say like post-global financial crisis all the way till the COVID shock.
Yep.
So that's more than a decade.
It's more than a decade, yeah.
So now inflation is back. Okay. Everyone is confused because of the tremendous amount of uncertainty coming from trade wars, coming from geopolitical shocks, coming from which way the Trump administration is actually going to go. And in fact, I don't think that even the Fed is very sure about it. Even the Fed's meetings and press conferences are not very illuminating. Like, the markets can't figure out whether this was good news or bad news. Okay, the first day they think it's good news. The next day the stock markets give all the gains back because they think maybe it's not good news. The Fed will soon face if we go along this current trajectory, it'll face a very difficult task, right? Because there are a couple of things which are happening. One is in the U.S. So in the U.S., first there's an immigration crackdown which is going on. Okay, it's still small. So, but if you think that accelerates, then it sort of makes it very hard to hire workers in many sectors. This will spike wages and therefore prices, creating inflationary pressures. The second thing are these trade wars. Now, yes, if there are tariffs, prices go up. It's not it's a one-time increase in prices. It might not trigger off inflation. But I think the channel through which this is working is because there's so much trade-related uncertainty. Companies have stopped investing. Okay, so then again, we sort of have less investment and negative supply shock, right? And the third thing is that if the Trump tax cuts go in, okay, then that's going to create a lot of deficit, and that deficit itself, might have certain inflationary pressures. Okay, that would be sort of like a positive demand shock. But most people are right now currently thinking that what we are experiencing or we are at risk is a negative supply shock. Negative supply shock means prices go up, inflationary pressures are created, and there is less output, so we might get into a stagflationary territory. Then the Fed's job gets really hard. Stagnation calls for lower interest rates, inflation calls for higher interest rates. So which way is the Fed going to go? So there you have to see about, the Fed's and most central banks say we give equal weight to unemployment and inflation, but when push comes to shove, they care more about inflation than unemployment. And the reason is a lot of them grew up during the 1980s when inflation was high, and there is some form of imprinting. So they put more weight on inflation. So therefore, the Fed is going to raise interest rates. That would be my bet. Now, Trump does not want interest rates to go up. He wants interest rates to actually be down, sort of juice the economy. At that point in time, I think the Trump administration will start meddling around with the Federal Reserve. And at that point in time, this is going to create a lot of chaos on world markets. If he does that, if he actually starts replacing Jerome Powell before his term is up, or
Yep.
or appointing someone
So just
unserious.
adding more uncertainty, more oil to the fire, basically.
So that's why interest rates are very hard to forecast, because they're getting this uncertainty, and the slowing down of investment should call for lower interest rates. But the inflationary expectations getting unhinged is going to call for higher interest rates. So I think the Fed itself is going to be frozen.
So, like a message to the LBO market, maybe a little bit less on the leverage side, just in case. So, interest rates will be tightened again.
Definitely, interest rates will either it'll not come down every time the market has bet on how. Let's say they bet on X number of interest rate cuts. The Fed has not delivered. Okay, so there is no Fed put out there. Okay, so the Fed looks at data and makes these decisions. Yes, Greenspan used to do that, but the Fed has actually changed, I think, since the global financial crisis. So they should expect higher interest rates. Okay, so lower leverage. Think in terms
maybe advisable. Huh? Maybe advisable. Lower interest, lower leverage.
Yes, definitely. So and especially when you have high amounts of leverage, and I see gyrations in stock prices. Yes, private equity doesn't mark to market, but if they should mark to market just to have an idea about how much risks they are holding on their portfolios. So therefore, I think leverage is going to be more dangerous going forward. Uncertainty plus higher interest rates.
Very good. And maybe a final comment on how about Europe and inflationary pressures versus interest rates?
So there, the inflation was mainly due to energy prices going up. And to the extent that has eased, greater production coming in from other countries, Trump seems to be in a tearing hurry to reduce sanctions on Russia, which means, Russian oil comes back on the market. The Europeans have found alternate sources of energy through Qatar, through the US, etc. And that makes Trump very happy because people are buying American stuff. So therefore, I don't see a big inflationary pressure there. What they are going to do is they're going to do lots of expansionary fiscal policy, okay, which in turn means that they are lagging behind in productivity. Their manufacturing base is under threat from Chinese exports. So therefore, I would think a lot of investment will go there, and a lot of opportunities, I think, will actually happen in Europe over the next 10 years, provided they get their act together and go along this path.
And follow the plan, which sounds inspiring, that has been rolled out right now. So thank you very much. This was fascinating, very interesting. So Pushan Dutt, Professor of Economics and Political Science at INSEAD. And it's always a pleasure to sit down with a colleague who's actually literally 2 doors down from me. No excuse to do it again. Thank you, Pushan.
Thank you for having me.